Welcome to the CLS Monthly Market Review. I'm Rusty Vanneman, Chief Investment Officer for CLS Investments. And with me this month is Grant Engelbart, again, Director of Research and Senior Portfolio Manager. Well, December was a crazy month. Give us some of the stats.
Yeah, thanks for having me back after a month like we had. It was a December.
Your good luck charm
for sure. Yeah, the worst month since 1931, worst December since 1931 is some of the headlines that are out there. Wasn't a great month. Usually it's a very strong period of time. The Santa Claus rally really never came this year. Global stocks were down about 7%. With domestic stocks down worse. So the S&P was down about 9, small caps down about 12. International stocks, while still negative, kind of were a ballast this month, down about 4.5%. You had strong relative performance from emerging markets, which is great to see. Diversifiers like bonds were positive by 2%, which is good to see as well. And then you have commodities and liquid alternatives were both negative on the month, but less so than stocks, which was also somewhat positive on a relative basis to portfolios.
I think you wrap it all up, as you said. I mean, first of all, it was a bad month for investors in terms of at least temporary short-term losses. But globally diversified portfolios did hold up relatively well. Right. In fact, in some cases, they significantly outperformed. Still down, but did a lot better than what the market suggested. I think a couple other takeaways. I mean, obviously, CLS portfolios are globally diversified, right. So we held up, again, relatively well. We still had absolute losses. I think another little tidbit, and you kind of touched upon, is the bond market. Last year, interest rates were actually higher, but the bond market actually had a gain on the year ever so slightly, right. Which I think is a pretty good little tidbit. Well, I think the reasons for the losses, I mean, we kind of knew about it. There was a backdrop that would suggest we could have some below average returns moving forward, which we've talked about. Valuations are rich. Corporate earnings growth has been fantastic and now is only really good. But right. Usually when it kind of rolls over like that, it usually, all else being equal, is not great for the stock market. And with interest rates rising, which again is very normal for the economic cycle, but I think what was really different is usually over the course of a 4-year presidential cycle, after the midterm elections, you usually have this period of political certainty, or relatively speaking, political right. certainty, and that obviously was not the case. And of all the reasons cited, that's probably the real reason why prices really got pushed down. And then you get negative price volatility that just sort of feeds on right. it. But speaking of negative price volatility, though, so obviously we've had a correction. What are some of the stats? How often should investors expect to see this sort of price action?
Yeah, volatility obviously definitely picked up, but really not to levels that are unheard of, and it didn't even touch levels that we saw earlier in 2018, which is important to recognize. Really kind of a return to normalcy in some degree. So once every 4 months, you'll typically see a 5% correction. Once a year, you'll typically see a 10% correction. Once every couple years, 15%. Once every 3 years, you usually see a 20% correction. We didn't quite get to a 20% correction on the S&P 500, but close, and that's, again, something we haven't seen in 3 years or more, so the expectation there is fairly normal to see that this year.
It's very natural, and it's very normal to see that kind of price action. We just haven't seen it in a while.
Right.
The nice thing about that is when the market does come back at those levels, usually moving forward, we get above average returns.
Absolutely.
Even more so than we usually do. Do you have some of those stats?
Yeah, over 75% of the time, returns the next year are positive, which is great. And returns are typically positive on a rolling basis 75% of the time, so that makes a ton of sense. But the returns are usually on an immediate basis over 20% higher, 22% higher the next year. So that, I think investors should recognize this is a time to invest, not a time to batten down the hatches. And
I agree.
Further losses could come, but the overwhelming probabilities going forward are that positive returns.
And I think that's the way to summarize it. December was tough, the quarter was tough, the year was tough, but I think 2019 looks pretty encouraging for a lot of reasons, and partly driven the fact that prices came back, stocks are on sale, and the outlook is a lot brighter.
Absolutely.
Well, thanks, Grant.
Thank you.
And thank you for your time and trust in CLS Investments. We'll see you next month.